As a market historian, you understand that these market advances, they're like tides. They come in intervals. Do you subscribe to the thesis that a breakout above 1,000 in gold could require a market consolidation, a resting period, if you will, for a few months as bulls gain the steam necessary to push the yellow metal to $1,200 and then $1,500 an ounce?
I think once we go over 1,000, gold is just going to continue climbing, similar to what it did with 100 back in the 1970s, almost 40 years ago, or similar to the Dow when it finally took out 1,000 in 1982. It just kept on climbing. Once gold goes over 1,000, that's going to be a global wake-up call, and people are going to be going into gold regardless of whether they understand the reasons for gold going up or not. They're going to see it as a red flag warning, problems in the monetary system, begin accumulating gold. So once we do get over 1,000, I think you're going to just continue climbing, and I think you're going to end the year 1,100. I think that's a very reasonable target.
The technical picture for gold certainly agrees with your forecast there. First, there appears to be a bullish reverse head and shoulders forming in the weekly chart. And I think this further supports the idea that we're moving much higher here.
And in fact, the charts, I think, are very powerful and very bullish. We did touch 1,000 a year ago, and then we've had the consolidation. We now have the base in place that's ready to move gold above 1,000 and sustain it in an uptrend once it goes above 1,000.
I agree. And, listening to some of the chat rooms, discussion boards, of the big traders out there, the folks that are in the trenches every day, I notice there are people who are nervous. They've been made nervous by much of what you referred to as the liquidation, if you will, of 2008, where there were so many margin calls, not just with the individual investor, but also in hedge funds and institutions and things of that nature, where folks were forced to sell their winning positions, i.e. commodities, gold, silver, even maybe oil to some extent, in order to pay off their crushing losses in equities. Some of that fear is beginning to subside as folks notice that gold remains strongly above not only its long-term 50-period moving average, but its 200-period moving average, which the institutions and hedge funds alike, they monitor those levels closely. And as a trader yourself, a longtime trader in precious metals, are you watching the tea leaves, and what else are they telling you?
Yeah, I like to see divergences in markets, and it's an important clue as to what's coming. And we've seen that recently here in the stock market and the gold mining stocks in particular, and gold price in general. In the aftermath of the Lehman collapse last autumn, the stock market went into bottom in October, and then we had a bounce, and we kept on making lower lows all the way until beginning of March. However, the gold mining stocks bottomed in October, and as the general broad market kept going lower, the gold mining stocks kept going higher, and they're basically twice the levels they were last autumn. That divergence suggests to me that there's a lot of strong hands, smart money, moving into the precious metals sector. The action of the gold price over this period of time as well, I think, is significant in suggesting that, maybe we've turned the corner here and we're ready to head higher. And then I look at other things, too. With the stock market, the T-bonds went to new low yields as they were seen as a safe haven last autumn. But as the stock market continued to go lower, T-bonds were not seen as the safe haven anymore, and yields have actually been rising on T-notes and T-bonds. That's another important divergence, and what it suggests to me is that bondholders are demanding higher yields because they see a reflation trade coming because of all of these bailouts and money printing going on by the Federal Reserve.
Well, I'd also like to address, as we wrap up here, the greenback situation. And this has been interesting, not just technically, as I look here at the charts, but fundamentally. I mean, we watched the greenback struggle for many, many years. A lot of people attributed a considerable portion of the yellow metal and silver's success to that downtrend. Well, last year, the downtrend came to an abrupt and violent end as the dollar soared to levels we just hadn't seen in several years. And every time it seems to go back down and retest those support levels, well, just like last week, it seems to bounce off there. Do you believe that all we're witnessing here is a counter-trend rally that inevitably will fail? And what are the implications for precious metals, James?
Yeah, absolutely. I mean, the dollar's been in a bear market for 40 years, ever since gold was $35 an ounce back in the 1960s. And you get bear market rallies along the way, but if you took any of those bear market rallies and concluded that there was a fundamental change in the dollar, you would have been penalized sooner or later. And if you look at what happened last year, we were talking about it a little bit earlier in the sense that, people were using the dollar as a carry trade, particularly hedge funds and institutional investors. They were borrowing dollars and buying assets in Canada and Australia and Europe. And when the deleveraging came after the Lehman collapse, they sold all of those non-U.S. assets, got the local currency, then converted that currency, the euros, the Canadian dollars, Australian dollars, and whatnot, into U.S. dollars to repay their U.S. debts. And so the U.S. dollar was rising because of deleveraging, not because of any fundamental factors. And as proof of that statement, look at what happened to the yen. The yen rose even against the U.S. dollar during this period of time because it had even a bigger carry trade position, and it's a much thinner market than the U.S. dollar. So the yen was rising too. But these are not reasons to buy the dollar. These are just bear market rallies, and these things happen in the course of a long-term bear market, which the dollar is in. And conversely, looking at the other side of the coin, the long-term bull market that the precious metals have been in. So there's historically a link in the sense that what's bullish for the dollar is typically bearish for gold. It doesn't always work that way. But a dollar bear market means generally a precious metals bull market. That's what we've been in for 4 decades.
Very good. Well, today's featured guest, gold money expert James Turk, founder and chairman of goldmoney.com. James, for listeners who'd like to access your latest reports at your website and for more information on all of your work, please tell them how to do so.
Yes, we can be found at goldmoney.com. And we're a very convenient, economical, and safe way to buy and sell gold and silver online. We're presently storing over $600 million of gold and silver for our customers.
Incredible. James, as always, continued success, and thanks for sharing your time with us today.
Thank you, Chris. It's been a pleasure.